Everyone is talking about the commercial real estate collapse. Office is doomed, retail is doomed, the commercial market is going to crash. Is that really the case? Today we're going to do a deep dive here specifically in Long Beach, talk about the dynamics, talk about sales, talk about pricing, talk about rental demand. Is office really dead? Possibly. Can you position yourself as the investor to take advantage of what's to come? Stay tuned as we hop into this interview. Hey everyone, it's Juan Huizar, president of Sage Real Estate. I'm excited today because we're going to be covering the world of commercial real estate here in Long Beach. I'm sitting down with Sheva Hosansade. Sheva is someone that is known throughout Long Beach, specifically with commercial real estate, by her first name, Sheva. She's been around a very long time. Her names are all around the commercial signs in Long Beach. And so she's going to tell us what is happening in the commercial market today, 2024. Is it a good time to enter? Are prices falling? Are there foreclosures? Is commercial really on fire and about to collapse? We're going to get right into it. Sheva, thank you so much for being here today.
Thank you, Juan.
Sheva, so our viewers know, we work together. We are two separate companies. I'm with Sage Real Estate. Sheva's with Coldwell Banker Commercial Blair. And Sheva, to your credit, you just became partner of the company.
I did.
And so there's not a lot of women in the commercial industry, and you've been kind of one of the pioneers early on. What got you into commercial real estate? How long you been doing this?
So thank you, Juan. And so I actually joined Coldwell Banker Commercial Blair in 2012. My father was a real estate agent, except that he did multifamily and residential. So growing up, I used to always hear him talk about his transactions, the real estate market. It was something that always interested me. And when I started to see the market come back in 2012 from the recession we had in 2007, 2008, that's when I knew it was the perfect time for me to get involved. I got my real estate license, bartended part-time to study and get my license. And then I joined Coldwell Banker Commercial, which is where I've been my whole career. And why I chose that firm is because my mentor at the time, Becky Blair, was the trailblazer of women in this industry. And I was lucky enough to partner with her and learn from her. And we were partners with each other for 10 years until she retired in January of last year. And that's when I bought into the company and I became one of the principals.
Awesome. So that's an amazing story, Sheva. Recently, Sheva and I have been partnering up together, commercial buildings, multifamily. And so we tell clients that when you hire us, you get two brokers for the price of one. So it's been working out great.
And two firms.
Yeah, and two firms. And so it's been great aligning myself also with Sheva, learning from her and vice versa. And so let's get into it. So people want to know, how's the commercial market doing in Long Beach? Okay, now when we talk about commercial, I'm going to explain a couple things. Commercial has a lot of different parts to it. We have office, medical office, we have retail, we have industrial, there's development, there's land, there's a lot of things going on. So it's very interesting when someone asks Sheva or I, how's the market? Mm-hmm. We need to say, well, what part of the market? Mm-hmm. Because all of it at times could be performing differently, okay? So today we're gonna be covering two parts. One is office, right? So we've been hearing that because of COVID and everyone's working from home and that no one will ever step foot into an office. And so we're going to get into that. Is that true? Is that not true? The other part is, well, how's retail doing? Because we keep hearing that this is the death of brick and mortar stores and that no one wants to lease space because everything's being sold online. Well, we're going to find out if that's true or not, because whether it's true or not, it's going to impact what? Rental rates and pricing. And because we're in the world of real estate investing, we want to know, is there opportunity for us? So Sheva, starting with office, Is office vacancy up or down in Long Beach?
Oh, clearly it's up.
Okay.
There is still a need for office. Office isn't going away. It's just looking different now. And people are downsizing. And because they're downsizing, there's still quite a bit of vacancy. When we looked at the stats on CoStar, surprisingly, CoStar has the overall Long Beach market vacancy at 10%, and in the downtown area of Long Beach at 17%. That seems low to me for someone that's feet on the ground, showing these office spaces, doing the transactions. It seems to me the vacancy is higher. If I was to guess, I would say that probably 20 25% is the vacancy, the real vacancy number in our city, and potentially even higher in our downtown because there's just more office availability. So maybe even closer to 30%.
No, so I understand. So what she was saying is that, hey, CoStar is giving us these numbers, but when she's looking over the numbers, it's hard to believe that we're only between a 10, 17% vacancy, because we know that COVID did play a big role in having higher vacancies in the office space. How does our vacancy, based on the numbers you just told me, how does it compare to other cities? Like, do we have more vacancy than, say, um, Marina del Rey, downtown LA? Like, how do we compare to them?
Maybe we would be less than downtown LA because there's just much larger inventory in the LA area. But overall, every sector in every market is feeling the same as it comes to office. It's all relative. So I don't think that we're better or worse. I think we're just in line with what's happening, with the fact that people are wanting to work from home more. People are going back to the office. They may not be going fully back to the office. It may be blended. I talk to a lot of people. I work 1 day, 2 days from home. I'm in the office the rest of the time. So they still need a physical location to go to. It's just a matter of downsizing. If you were in a 5,000 square foot space, you're now probably in a 2,000 square foot space. So it doesn't mean you're leaving the market altogether. It just means you're looking for something else that is smaller, where everyone had to have a private office before. Now they're probably sharing. Two people share an office because that person's in this many days a week and the other person's in this many days a week. So it's just shifting. There's also having more amenities is a plus. If you are willing to upgrade the space, put in different type of flooring, more of a creative space, it's drawing more attention to that property versus just traditional office. Also, other buildings, owners that are forward thinking and have the capital and want to improve their properties are creating community space. Areas like what WeWork does, where people can come and get to know each other in the building, an outdoor space or indoor space, and it's just a shared common area that they can take a phone call or take a break, and it's inviting. And that's allowing people to be more attracted to your property versus all the other competitors.
Got it. Thank you for that. So with vacancy up in your perspective, right? What is that doing to the rental rates? So like if I'm an owner, am I getting less per square foot than before? Or if I'm a tenant, is this a good time to maybe look for office space?
So if you're a tenant, absolutely. There's so much vacancy and there's more negotiating power on the tenant's perspective now than there would have been before. Rates haven't changed a whole lot, surprisingly. They have come down some, no doubt, but not significantly with what you would think because of everything that's happened with COVID. But landlords are much more willing to do a deal now. They want their spaces rented. Even though they may be asking a certain price, it doesn't mean that there isn't room for them to negotiate and come down. They're also willing to do more tenant improvements, upgrades to the space. And there's also an ability to negotiate free rent period. Before, you could ask for free rent or rent abatement, as it's commonly known in our market. But before, they may give 1 month because the landlord is still covering costs and doing improvement work. Now they might give 2 or 3 months if that's what it's going to take to get the deal done and get the tenant into their space.
Got it. Got it. So vacancies up, rental rates are still the same for the most part, but you are able to negotiate additional things, tenant improvements, repairs, and stuff like that to make the space suitable for your business needs. What does this mean? So that's kind of covering the rental side of what's happening. What does this mean for office sales? Are sales up? Are they down? What's happening?
They're somewhat down only because there's buyers are concerned about buying office. They're not sure where the market is going to be for office in the future, though there is still a market for it. How much of a market? We've seen a lot of office conversions into residential development, and more so ground up development, where they're actually demolishing the building, going to do probably some level of subterranean parking, and then going to be utilizing the land for residential mixed use development. And that, for now, in our market in Long Beach, majority of that is happening along the shore, off of 2nd and PCH specifically. We know 3 or 4 large properties, office buildings, that unfortunately are going to be, well, fortunately and unfortunately. Fortunately in that There is going to be development. The area needs it. We need more residents. But it's a very small part of the city that doesn't have any other office buildings within proximity. So all those office tenants are getting relocated, and they're having to get relocated to Seal Beach and even Los Alamitos because there's no other options for them in that specific part of the city. So we're losing some office tenants now to our adjacent cities because of that. But so with sales, cap rates are going up. And I know that the sellers don't like to hear that. The investors are probably very happy because for a very long time, I'd say for about a 2-year period, 2 to 3 year period, we had a consistent 5% cap rate in our market. And so it was very easy for us to even quote out sales prices at the time because we just knew 5% is what the market is calling. And at one time, even maybe even less at some points with all the development, especially in our downtown. Now the cap rates are up and we're not seeing them anywhere below 5.5. We've seen in a lot of cases, and we have some charts to show you as well, where they're going up to even 6 to 7%. So what does that mean? That means that the purchase price is coming down. Sellers are more motivated. If you want to move your property in today's market, you have to be realistic on what the value is going to be, and the cap rates are going to be more attractive and in the buyer's favor.
So let me cover cap rates, and I know I've done videos specifically on cap rates. So cap rates is essentially a rate of return based on the income that's being produced. Now, there's going to be a ratio, but in the most simplistic way I could tell you is if you were to buy a property cash, then the cap rate is considered the rate of return that you would be getting. So before, I guess a couple of years ago, what Sheva's saying is that the investor was willing to buy an office building with a 5% rate of return. Now that same investor, that 5% is not good enough. They want it to be 6 or 7% rate of return. Well, if you've been watching our channel, you know that when the cap rate goes up, there's an inverse relationship to the value that's going to drop down. And so right now, what she was saying is that that same buyer can just simply get a better deal. Mm-hmm. And they're going to be able to negotiate a better deal. So if someone were to say, hey, how's the market? I think if you're a seller, it might be tough because it's not worth what it was, say, 2 years ago.
Absolutely.
It's not. But if you're a buyer, this might be a good time to enter.
Absolutely. And what's drawing those higher cap rates? It's the interest rate. When interest rates go up, that means purchase prices have to come down. And that's ultimately what's happening. And there is still a gap in the market of what buyers want to sell their properties for and what sellers want to sell their properties for and what buyers are willing to pay for the property. And trying to bridge that gap is still taking time. But ultimately what a buyer was paying for a property 2 years ago at 4.25% cap rate, and now they're paying 6 to 7% cap rate. There's just no way they're willing to pay the same price that they were willing to pay for it then. And so once the rates come down, which supposedly it's going to happen sometime this year, we're already in the second month of the year, and that hasn't happened. But everything is pointing in the direction that the Federal Reserve is going to lower rates, and it's going to come, but likely in the second half of the year.
Sheva, when it comes to office space, I mean, some people might be wondering, hey, are these like high rises? And some of them are, right, where there's the big sales, but then some aren't as big. I mean, I've seen some office spaces where they're 2,500 square feet or they're standalone. What do you see when it comes to sales? Like, what do you see more of?
It's a combination, but right now what's really selling is smaller owner-user office investments. Or not even an investment. An owner-user is somebody that's ultimately buying the building to put their business within the property. And typically it's some sort of office-related use. That is because financing is still very attractive for owner-users, and you can get SBA with 10% down. And so those buyers, even though the rates are higher, they're still looking for properties, and because the interest rate is higher, the prices are coming down, they're still taking advantage because they can always refinance down the line and obtain a lower rent.
So it's possible that it's possible that a smaller office building, and I'm just going to use an example, maybe 2,500 to 10,000 square foot office building, it's possible that that if a owner user comes in, it's possible that that owner user may not care so much about the 6-7% cap because they're more looking at it from a utility perspective. So if you're a seller watching this and you're like, oh my gosh, I can't believe it's at 6 or 7, I don't want to sell. Not so quick, not so quick, because you might be in that special unique size where the office space is just not that massive, and there's someone that could come in, occupy it, meet the SBA requirements of having to occupy at least 51%. And maybe your value is not as bad as you think, but feel free to reach out because that could be true.
If I may share a story, Juan,
Sure.
that we have this office building in a bad area of the city.
We don't have bad areas, do we?
Well, some. It's a corridor that just is not the best corridor within our. It's close to the downtown, but not quite. But the space was built out for medical. Couldn't rent it. We've been trying for about a year and a half. It's lacking parking and the space is dated. It doesn't meet today's standards for medical use. And so someone would have to come in and put a substantial amount of tenant improvements and improvement work into the space. And we've lowered the price a few times. Finally, we got an unsolicited offer for sale. Someone decided, hey, I like the building, but I want to own it. I don't want to be a tenant. The offer wasn't that attractive, but that got the seller thinking, well, what if I went and listed the property for sale? What kind of interest would I get? And so he picked a price. He said it has to be at this number, and if I get to this number, I might consider selling it. We put it on the market, and within a day and a half, we already had 5 people contacting us, and we have an offer in hand right now that we're negotiating, and we're not far off from his number that he wants. So sometimes you find that these people don't want to rent the building. This was an owner user. So he wanted to put his business there. It meant that much to him, the buyer that we're working with now, that he's willing to pay the price, get to our seller's ask price in order for him to be able to put his practice. And he didn't want to rent. So there's definitely buyers like that out there, to your point.
Yeah, so that gives us a really good example is that it's not all bad for everybody. It's a unique situation. Sheva, well, listen, I think it's amazing that the cap rate is 6 or 7, because I'll tell you what, we sell a lot of multifamily, and I'm not seeing a whole lot of 7 cap properties, meaning that if you're an investor and you want the highest rate of return, it might be maybe that an office building is the way to go. And if that's the case, Sheva, what's the inventory like? Are there a lot of office buildings for sale right now?
Yes, there is, and there's some larger ones, especially in the downtown area, that's on the market for sale. I'm potentially going to be listing one of them pretty soon myself. There's several throughout the rest of the city. I would say it's not as high as I'd like it to be, but especially on an owner user standpoint, I think there's a lot of opportunity.
Thank you for that, Sheva. A lot of times we watch the news and I keep hearing it, and people keep asking me, hey, there's this wave of commercial foreclosures coming. I haven't seen this wave. Have you seen anything? I mean, your boots in the ground, like, are people that you service and you help, are they losing their buildings right now?
I haven't had one, but okay. I have had 2 or 3 conversations with clients where their loans are due and they're starting to think about what they're going to do. So, but they're getting ahead of it. They're already having the conversations now about what's their timing. Do they want to sell it? And we've got 2 or 3 that we're having conversations with, but no, I have not had one client foreclosed on. We were expecting a much harder recession last year. In January of last year, I attended several market forecast events, and the economists that were there were painting this very negative image of what real estate's going to look like in the next 2 to 3 years, and it was going to be doomsday. But we haven't seen that. Did it slow down? Absolutely. 2022 was a slower year. There weren't as many sales. I think buyers were just waiting on the sideline to see what's going to happen with the economy, what's going to happen with the market. And I think those buyers are tired of waiting. I think that after a year, nothing has happened. And we're back to business as usual. This week specifically has been one of the busiest weeks for me. I've had 4 or 5 leads in itself, and people want to get back to business again. So I'm optimistic in 2024. I do think it's going to be a good market for everybody. If a buyer wants to buy, now is the time before the rates start coming down, because as we mentioned earlier, as soon as the rates do start coming down, the prices will stay where they're at or maybe go up slightly. But right now, for the sellers that want to sell, there's still some negotiating room from the buyer's perspective.
Sheva, so I agree with your statement. One thing that I tell people is, hey, 2023 was slow overall. It was a slow year in investment sales, commercial sales. It was slow. But the first week of January 2024, two things could have happened. One, all of a sudden there was this consumer confidence, and I'm thinking, well, were people just waiting for the new year? Were they just waiting? And then two, people's acceptance of where the interest rates, they came to terms with it. So what's that mean? That before they were fighting it. Well, I don't like this 6% interest rate, but now they've normalized it. And so those two things,
which historically 6% has been, I mean, the standard. I mean, it just happened to be, we dip below that, and that's what investors would like for us to go back to. But we may dip down from that, but we're probably never going to go back to that 4.25 or 4%.
There's a listing that Sheva and I have together. Yeah, and it's on 4th Street here in Long Beach. And we were on the market for literally a year and not much activity. And now we have it in escrow. And it just speaks to the fact of what we're saying is that it's not really a dire situation. Now, we did have to discount the price. That definitely happened a couple times in order for us to be attractive enough to put that in escrow. But now we have that in escrow. And last year, it was hard for us to envision that happening because of the conversations that we were having and the fact that no one was really calling us on that specific property or any of our other listings. And so 2024 is a much, much different year. So I'm going to wrap up the office segment because we're going to move over to retail. Is if you're an investor, cap rates are up. Okay. If you're a tenant, the rates are still the same. So don't buy into the hype of, hey, office rates have dropped. Sheva's telling us that is not the case.
Slightly, not significantly.
Correct. Are you able to negotiate tenant improvements? Yes. A couple more free months? True. So that's true. If you're a seller, I suggest that you sit down with Sheva and I because you need to explore your options. Because if you're someone who's thinking about selling, well, a couple things. Either how's the loan that you have and what's your overall game plan with the building, okay? Because it's not every situation is hey, you should. Sometimes people call me and they say, this is the bad time to sell my building, right? And the answer is, for us, it depends.
Yeah.
Let's talk about your building.
What's your needs?
Right.
And what's your personal needs?
And what's the situation with the property? Because we just finished telling you that if you have a smaller office building, this might be a great time to get in because SBA is doing a lot of amazing things. All right, Sheva, so let's get into retail. And so let's just describe what retail is. So retail is well, you give us your explanation of what you see.
You know, I actually appreciate that you mentioned that one because there's such a misconception. And in fact, recently I had to explain to somebody the differential between office and retail because they're an office user, but they want to go into a retail property and they don't understand the additional costs that come with being a retail tenant. And the differential really is it's mainly ground floor space. So as long as you're on a ground floor space, you have drive-by traffic, signage opportunities, walk-in traffic, all of that allows you to generate more business. So it's considered retail. And because you have all of those advantages in trying to get more clientele because they can see you, they can drive by and go, that's a hair salon I never knew existed. I'm going to be interested in that space. Or for an office type retail user like an insurance company, benefits from being on the ground floor space because somebody can drive by and say, oh, I need insurance. Let me stop here and talk to these people. But what people don't understand is that because you have those benefits, you're also going to be paying, in addition to the base rent, which you would pay in office, you're going to have, in most cases, something called a triple net fee. And that triple net fee is the direct cost of the taxes, insurance, and maintenance. So whatever the landlord pays in taxes, whatever they pay in insurance, whatever they pay to maintain the building, that gets bundled into an overall cost that's broken down on a price per square foot. People commonly ask me, well, what's the common triple net fee? There is no such thing because it's dependent on the property. That guy's taxes differ from this guy's taxes. So Could they go as low as 20 cents? Yes, I have a property on the market now at 20 cents per square foot because he's owned it for 50 years. Could it go as high as $1? Yes, because there were brand new builds with higher expenses. So that's the triple net fee. In addition to that, you pay all of your retail expense. I'm sorry, all of your utility expenses. So in an office space, utility for the most part is bundled into the base rent. There isn't typically a CAM fee or triple net fee. So it's a little bit cheaper to go the office route. But if you want the benefit of having the visibility, the signage opportunities, the traffic, then you want to consider a retail space.
Sheva, thank you for that. So how is retail space doing from a leasing perspective?
It's actually doing quite well. Last year, when interest rates went up and the sales market slowed down, I actually pivoted my business and I went where the market went, and the market was leasing. And so I did more than 50% of my business last year in just leasing. And I'm okay with it. You know, I love helping businesses because I live in Long Beach, I work in Long Beach. And so whenever I put a retailer somewhere, I know that that's in turn benefiting the community that I live in. So I love doing leasing. So it's doing okay. CoStar would tell you that the vacancy for retail is at 4% in the overall market of Long Beach and 5% in our downtown. Also seems low to me. I would say probably our vacancy is 10 to 15% in the city and maybe slightly more in the downtown area, just because of all the new development projects that are just completing now that are adding significant amount of inventory to the downtown market. But they're renting. Even the ones in the downtown area are renting. So there's still, I guess, an appetite for businesses to continue to expand or relocate. One sector in retail that has slowed down for me, I can't speak to other markets, but restaurants, surprisingly, we have heard from several restaurants. We had 3 secondhand or second generation restaurant spaces on the market for lease, which we would think normally we could rent those fairly quickly. 2 of them are still available. One of them we finally rented, but just through our cold calling efforts and finding the right operator for the space. But what we've heard is that the high cost food cost, the high cost for labor, and the lack of being able to find qualified staff all bundled in is making it much harder for these restaurants to be successful in this market. And unfortunately, when inflation is up, funds are tight, people are eating out less, and so the restaurants are seeing sales have dropped slightly. Not to say that the ones that are, some are doing exceptionally well, others are struggling, many of them are surviving, but we're finding that it's not a market right now for restaurants to expand into.
Interesting, because one of the things I've seen in the past is restaurant owners want to open up where there was previously a restaurant because there were so many improvements done. It was built out to be a restaurant.
Absolutely.
And it's so expensive that it makes sense for them to open up there. But even with that being the case in your scenario, it's been tough to get those tenants in there.
It has to be the right location. It has to be the perfect location for them where they know that they're going to be successful. They're not willing to take a chance on a lower end unit or location. We have this beautiful space, but it's not in a great market. It's a little bit of a lower part of the city, and we can't rent it. I mean, it's dirt cheap rent. Everything was left behind, even the tables, the spoons. I mean, you could literally go in there, turn the lights on, and start operating it as a restaurant tomorrow, and we're finding it very difficult to rent.
Sheva, and this is more of like a general question overall, but if someone were to ask us, hey, what's the going price per square foot in retail on an average perspective? I know there's going to be a range, but what would you say?
It's a range, right? In fact, I just pulled comps for downtown. Surprisingly, the rates are high. And why are they high? It's because we've got 20 to 30, maybe 40,000 square feet of just brand new first generation retail that is hitting the market between last year and this year.
Okay.
We had the Ani project, Raintree Partners, and Alliance Partners finish their construction projects. So those are, with 7, 10 and 20,000 square feet of retail coming to our downtown. So what does that mean? That means they're asking between $3.25 and $4 per square foot triple net. So that's driving up the overall market. So where people were previously at $2 a square foot, they're now at $2.50 or $2.75, or even getting to $3. So we are seeing the rates go up, but it's, it's relative, because if you do go into one of these newer projects, you're in a brand new development project, brand new building with, hundreds of residents that are directly above you. So it can be justified.
How does this price per square foot compare to the on average office price per square foot? Because I know it's going to be less.
It's significant, yeah.
But so what are you seeing in Long Beach?
The rates for office or retail?
Office. Just so we could compare to what you just mentioned.
We're seeing, I would say on the lower end, about $1.50 a square foot. And on a higher end, I've seen some spaces at $3, but that's very high. I think that has to be like an A-class office building to be at that rate.
Got it. So that kind of covers our rental portion in terms of retail, because we're doing two things. We're going to cover, well, how is it from a leasing perspective, but let's talk about sales. So, because it sounds right now like retail is actually performing really well.
It is. We're doing quite a bit of leases.
Okay.
So, now on the sales side, similarly to the office side, cap rates have gone up. We have a center, beautiful property now, very close proximity to the college, Cal State Long Beach. And we're just, to our surprise, we're getting offers at 6 and 6.25 cap rates. And to me, knowing that market and that location, I wouldn't think that that's even close to a 6 cap. We've worked the buyers some, and we're really close to going into escrow soon with a buyer that will be at a 5.5 cap. So that makes more sense to me. But that same property in 2022 would have sold at a 5 cap, absolutely. So there's activity, but they're negotiating a little harder, Absolutely.
and the buyers are I think what they're trying to do, the buyer's trying to protect themselves. If in fact, if you buy it in 2024, and should the cap continue increasing, it's going to drive down their value. And so there's a strategy behind what they're trying to do, is almost like maybe bracing themselves.
Sure.
Could be one, or simply knowing that sales are slower and they're just trying to take advantage.
The buyers are a little bit more aggressive right now. And do I blame them? No. If I had the opportunity to, knowing where rates are, of course I would try. But there is this gap we're still trying to fill with where sellers' expectations are with value. They want the 2022 values, but we're not there. So we're trying to make sure that the sellers know, hey, unfortunately, prices are coming down. And then, of course, getting the buyers to be a little bit more realistic on value rather than just trying to get the best deal that they can. Because, if this property sold at a 6.5 cap or 6.25 cap, I mean, I'd buy it. So it's just, that's not realistic. And so we're getting these aggressive offers. I try to just tell my sellers, don't be offended. It's just where we're at. Let's go back with what works for you, and let's try to bridge the gap. It was harder last year to bridge that gap. This year, we're starting to see more movement from both the buyers and the sellers.
Sheva, talk to us about, is there a lot of retail inventory for sale right now?
Absolutely. Actually, I'd
There
say
is.
even a little bit more than the office market. In fact, we pulled comps recently for this center, and yes, there are. Absolutely.
And so like anything else, the more inventory that hits the market, the more it's going to drive down the value.
Yeah, and we're seeing properties even getting listed at a 6 cap in certain parts of the city. So the sellers are being more realistic too now and saying, okay, if I really want to move my property, the cap rates are not at 5, 5.5, 5.25. They're 6, 6.25. I mean, so they are going up. And so we're seeing a lot more of that. In fact, just even from 6 months ago to now, it's been a change.
Got it. Well, thank you for that, Sheva. I'm going to go into just a quick conversation about mixed-use properties.
Okay.
I know that we're trying to sell 2 of them here in Long Beach, and there's challenges. So what a mixed-use property is, in most cases, you have commercial use on the first floor, which would be what we're talking about, retail, and then you have residential on top. Sometimes it's on top, or sometimes it could be sat behind. Now, a lot of you would think, oh, that's the best of both worlds. You have commercial, you have residential. Clearly, that's easy to buy. but that's not been the case.
No.
Talk to us about why are there challenges with mixed use properties?
It's the lending sources, and the problem is for whatever reason, lenders think that mixed use is a riskier asset than it would be if it was just standard residential or just standard retail or just standard office. And so to obtain financing on mixed use, on average, lenders require 40 to 50% down. That's a substantial amount of money, and not most buyers have that kind of capital available just to put down on the down payment to purchase the asset, that even putting money into renovating it and other things that they have to do. So we have a lender, more of a broker lender that Juan and I have worked with, and he can do, and there are some mixed use lenders that can go down to even 25% on a mixed use property, but the trade-off is the interest rate is higher. And one that we just got quoted recently with a 25% down at a 9% interest rate. And that is high, 9%. So if you wanted to get your rate back down to that 7 or 7.5 on mixed use, you'd have to be at that 40 to 50% down. So that's the challenge. That's why it's very difficult to get into that asset type.
Sometimes owners, because we both speak with them, they have a mixed use building and then they're using the cap rates that are lower, which would then therefore benefit them, of properties that are not mixed use, right? So they would compare it to a retail, or they would say, well, hey, compare it to a multifamily, and they're going to try to drive that cap rate down. But when we're looking at mixed use, we really should be comparing it to other mixed use properties.
Absolutely, absolutely. That's the only way, in my opinion, to comp it, and that's how I do it. When I'm looking at a mixed use property, I'm only looking at what other properties are mixed use and the breakdown of the units and what are they trading for. There's a market for it, absolutely. I've sold several, and Juan and I have one in escrow now and one on the market for sale. It's just a smaller pool of buyers that you're working with that like mixed use, that can afford mixed use. And I think they're great properties because you benefit from both. You've got retail and you've got tenants. So especially if it's multi-tenanted, significantly multi-tenanted, somebody vacated, it's pretty easy to get another tenant within the space. But that's the biggest challenge is getting the financing. Now, what we're negotiating more on, and you might even speak to this too, Juan, seller financing has been a key in some of these projects and properties and trying to get them sold. Because if the seller is willing to carry back the note and in essence be the lender on the property, then they don't have to deal with having to pay these higher interest rates or, having to pay the significant amount of money down. And therefore, we can get the seller a little bit higher value out of the property.
Yeah, and that's what I would say. And that's true to anything we've done in multifamily. Sometimes we'll sit down with the seller and they'll say, well, this is what I want for my multifamily and I won't take anything less. And I'm like, well, some cases, to what she was talking about, is since you've paid off your loan, you don't have a loan on it, is it possible that you would be willing to play the role of the bank? Now, in that situation, you could generate a better offer. Why? Because your interest rate's going to be more favorable to the buyer and maybe the down payment might be better. But there are lots of benefits to consider doing seller financing. And one benefit to the seller, you're going to get the price you want, because we have lots of potential investors that call us and say, I'm looking for someone willing to carry the paper, carry the note, different terms that are being used, but it's all the same thing. Can you find me a seller who wants to sell and play the role of the bank? And so in that situation, I think it's great.
And from a seller's perspective, it can offset the cost of taxes.
A lot of benefits. A lot of benefits. Sheva, I'm going to wrap up with the questions. Is there anything that you want to tell us of what you're thinking, what you're seeing, what investors are telling you in 2024, or what can we expect looking a little further, 2027? Like what do you think?
I think we're gonna be back to normal for sure in 2027. I even think by next year. This year, there's still a little, we started off slow. The January was a very slow month, but February has picked up substantially. And I just think as we get closer and closer to the end of the year, the election's gonna be a huge telltale and what, the next 4 years are gonna look like. So I think optimism is the word I've been using. I'm very optimistic about what the future is going to look like for real estate, for business owners, for business in general. So, you know, there's never, people ask me, when's a good time? When you're ready, it's time. That's the time. It doesn't matter about where the market is. The market is always going to go up and down. We can help you with your goals in any market. So reach out.
I love it. So there you have it. Sheva, thank you so much.
Thank
We're
you.
gonna have Sheva's information down below. If you want to contact her directly, she's a professional, she's a pro. She's got my stamp of approval. I know that she knows what she's doing. I get to work alongside her. And so make sure to like, comment, and subscribe. And that's all for now.